Okay, good afternoon, everybody. It's Alex Chisnell here, and I'm joined by Stuart Chapman from Draper Esprit. Good afternoon to you, Stuart.
Hi, Alex.
So thank you all for joining us. This is our second session of day 4 here at the Festival of Startups. Just had Stepan Galiev, Investment Director at Dragon's Den, speaking this morning's session. Those of you asking about replays, we are getting those over to us today, and we'll be letting you know where we are going to put them, because I know I've had numerous inquiries. People want to catch up because they've been busy working while these sessions have been running. So as I say, I'm Alex Chisnell. I'm a content director here at the Festival of Startups and host of Screw It, Just Do It, #1 rated entrepreneurship podcast. And I'm joined by Stuart Chapman, who founded Draper Esprit 2006. I think you told me, Stuart, is that right?
That's correct, yeah.
Yeah, and before that you were with Casanova and 3i, so similar landscape that you've been in for a number of years.
Yeah, so I joined 3i back in '92. I was doing arbitrage systems for Midland Bank, HSBC.
Huh.
Sorry to date me.
Yeah.
And then as a graduate of Midland Bank, you could jump to a graduate of a sister company, and Midland owned some of 3i, and so that's how I got into venture capital.
I see. Okay, and Draper are, I know, one of the leading venture capital and private equity companies here in the UK, but you invest in European high growth technology companies who've got global ambitions, the likes of a Free Trade, a Revolut, a Graze. You probably give me some better examples as well, I'm sure.
So we do enterprise, consumer, digital health, and semiconductors. So we have about 25% of our portfolio in each of those categories. And whether you're into health or whether you're into the latest silicon at GraphCore, that's what we tend to invest in.
Great. And look, everybody joining us today, we've had loads of questions coming in on this morning's session. I know there are a lot of entrepreneurs out there trying to find the right funding route for them at whatever stage of journey they're at. So we're trying to demystify venture capital funding today. Tiny bit of housekeeping, just to let you know. Questions, you've got 2 buttons on the right hand side. You've got the live chat, so you can pop anything in there, and you've also got the questions tab just below it. So if you'd like to use that to drop a question in, you can use that as well. So to start things off, really, Stuart, could you give us an analogy of what venture capital means to you, and also maybe why an entrepreneur should be considering it as an investment option for them?
Yeah, and please forgive analogies, because I love them and I butcher them. So I see venture capital as trying to find the fastest possible water. So this analogy is I have my canoe, and I have my entrepreneur, my founder. I don't know what you call a canoeist, the pilot of the canoe, and we try and find the fastest possible water. We do that because even though it's a bit bumpy and there's a few rapids, we will go faster than the market. The water will push us, but we will stay in front of the big guys. When the water plateaus, that is probably where venture capital moves more into private equity. And the private equity is more of a speedboat, whereas the speedboat can go much faster than the big guys to stay in front of them. It doesn't really work very well in choppy water. And so choppy water is risk. Mm-hmm. And so this is the analogy that I do as a venture capitalist. We're always trying to find the fastest possible water. For entrepreneurs on their journey, I always view venture capital as an escalator. And at the bottom of the escalator, you have your friends and family funding, and then as you go up, you pass the baton on to angels, and then as you go from angels, you might pass it on to institutional capital, which is people like myself who raise money from pension funds to put into a collective pool and then to invest in a portfolio. And then in the venture capital industry, you have guys that do small deals, big deals, late deals, pre-IPO deals. And my job is to keep passing the baton on to funders who will fund the greater story. all the way up to the end, which is either you do a merger, an acquisition by a big company, or maybe your own IPO, where you're tapping into different resources. But if you can view life as an escalator, then you get the idea that your job as an angel investor is to get the business so far that it can hit the milestones to trigger the next capital.
Yeah.
And then obviously when it comes to me, my job is to get the business probably into a financial shape, i.e. producing revenue and producing metrics, to a point where we could get the next capital. You had Anthony on from, Anthony Fletcher, and from Gray's perspective, our job there when we put our initial 50,000 in was just to get a prototype that worked.
Right, was it?
Yeah.
Interesting. Okay.
And then we put the equity in to get a business going. And by the time we got Carlyle in as a private equity investor, we had to show that we could demonstrate profits.
Yeah. Okay.
And that was our journey for our escalator on that business.
So that was, that was a really good conversation, actually. Those of you who missed that, we will have the replay up of that with Anthony Fletcher, CEO, former CEO of Gray's. He was saying, so that was with Carlyle, you say, and what was the timeline with that from you putting in that initial 50,000? Because they eventually, I think it was September this year, Unilever was the buyout.
2007, I'm guessing. It was just before our 2009 fund.
Right.
So because the big equity check came from the 2009 fund. So it must be 2007, 2008. We must have done the original 50,000.
Yeah. Okay. Really interesting story, Gray's, if you followed that. And who do you think should apply? Maybe just add a little bit more. And maybe before that, actually, where do you see the different value being added? Like in somebody's mind, for an entrepreneur, they might think within an angel investor, they're getting more access to the knowledge that that investor can actually bring. They can kind of tap into their contacts, their network, their knowledge. Where do you see VC private equity adding the value there?
I guess a quick, my expertise is venture capital. If I get a quick history lesson, very, very quick. In the 1930s, the UK government identified that you could either get bank debt or bank overdrafts, for a trading company, for short-term issues, or you could go public and get long-term capital there. And so by 1945, they published the Macmillan Gap, which is now a famous students' case study about this capital that is risk capital that you can't get from established lenders. This was the catalyst to the formation of 3i in this country and around the world. Other had their own stories. In Europe, all the way up to mid-1990s, even late 1990s, venture capital was everything. It didn't matter. If it was risk capital, it was deemed to be venture capital. It was only as we got through 1990s that we realized there were different skill sets. If I'm funding the purchase of a company or the change of ownership of a company in a profitable business, that's private equity, that's financial engineering and architecture. If I'm taking a new venture, then that's risk capital and that's venture capital. So when I speak, please forgive me, I will be very biased towards early stage risk because that's my background, but they are two different worlds. Private equity normally means some form of maturity. You have been trading, and so accountants and lawyers are the best kind of gatekeepers into that world. In my world, it tends to be trying to do something new, trying to push the boundaries. And so to go back to your original question, we have about 3,000 people approach us every year. Now, my colleague tends to say that that's a vanity number because really there are about 1,000 projects that kind of fit the mandate of what we do. It's in tech, it's the certain size. And then of those 1,000, we probably, one partner will look at about 500, and then multiple partners will meet over 100, and then at the end of the year, we do about 12 new transactions, a year. So the funnel is quite wide. People quite often ask me, what is the difference between number 12, and number 13?
It is a good question. Yeah.
And I probably say not a lot. I mean, it's probably the one at 12, the person who was pushing it probably loved it 1% more.
Really? Yeah.
And the reason being is the relationship between the venture capital company and the entrepreneur. I mean, it can be 7 to 10 years to build a big company. Maybe over 14 years if you're going to realize, that big company. And so the relationship over that journey, needs to be based on a passion for what you're trying to achieve, a commitment to each other that you're going to do it together, and actually some enjoyment. And so when you get down to that kind of 12 and 13, you really are talking about how much do you really, as a VC, you're going to do 2 deals and 2 new deals a year.
Yeah.
Do you really want to spend 7 years with that company or with that product or that idea? And so you could get right down to that level.
And do you ever get to the stage where, say, that number 13 or 14, you would give them that, come back in 6 months or come back in a year, here's something to work on, here's a couple of takeaways for you? Or would you look to pass them on to a partner organization that might be a little better fit, or just walk away?
It's a really good question. If you want to know, one of my biggest bugbears with venture capital, I'm an entrepreneur, and I created Esprit, and we built Esprit as a business, not as a separate individual fund. And then we took the business public. So obviously, when I fundraise, I sit in the shoes of the entrepreneur fundraising, and so I know how much it sucks. And one of the things I hate is venture capitalists won't say no, and they won't say no because of optionality. You, the entrepreneur, are trying to do something that's new, that's novel. No one knows whether it's going to work. And so actually, you're just always trying to buy an optionality. So if I ever got a story from a VC that said, do this in 6 months and come back, I would really question, are you sure? Is this just a soft no?
Yeah.
Or actually, am I outside of your mandate? Am I reason? From a Draper perspective, what we have chosen to do is we have worked out that we're not very good seed investors. There's a very different skill set. And so we have become, but we're quite good asset allocators. So we have become a limited partner, i.e. an investor in 25 seed funds in Europe. And so we partner with those seed funds to help us in that earlier stage. So it's not a direct relationship with us. So if an entrepreneur does come to us, and I see one of the questions about food, let's say one does come with us with a food investment, we would actually refer them on to 5 Seasons based in Paris, because they're the experts in early stage investing in that category, not us.
Yeah, but it's obviously, you've built that up over time, haven't you? By founding the company in 2006, and you've developed those relationships, and now it's pretty broad, I'd imagine, those 25.
Yes, we run a 2x2 matrix. Geographies we're good at, geographies we're not good at, sectors, top niches we're good at, and niches we're not good at. So you want to be obviously in the top right. You want to be in an area where we're underrepresented, and you want to be in a technology area where we're not good. But we work on the basis you have to have one of those two as a seed fund.
Okay.
So we have geography seed funds and we have technical seed funds.
And it was interesting chatting to Stepan earlier with regards to deal flow and how that's changed though literally in the last 9 months, and the amount of money in the system that people are, what's the risk level at the moment. And what are your thoughts on what you've seen? Clearly, when you look at the obvious figures, there's hundreds of, I think it's something like 300,000 businesses have been founded in the UK alone this year, which is bigger than normal. And whether that's a product again of people being made redundant, people deciding what the hell, if I'm ever going to do it, why not do it this year? What have you seen? What kind of trends have you seen over the last 9 months in your space, would you say?
Again, so if I kind of limit this just to my subset, so in high tech, high growth type propositions, there is definitely a flight to perceived quality. And I say perceived because you're still talking about very early stage businesses, and so that perception might be the quality of management team that they may have been able to hire, the quality of investor they've been able. It might not actually be fundamental quality; it might be a perceived. And you are seeing substantial rounds being raised at eye-wateringly high valuations. If I take our own investment, we have an investment in Stride, which is a seed fund, which is invested in Kazoo, the online car, reseller. That business is run by the most exceptional entrepreneur I've met. Here in the UK, Alex Chesterman.
Really,
he has been able to raise several hundreds of millions in this COVID market. So there is a flight to quality at that top end. There is a lot of capital coming into the market for access to that top end, and I think that's because they don't have many places to put their money. And then on the other side, and I'm a big Euro fan here. Europe has never been short of intellectual smarts. The schools in the UK, the schools in the rest of Europe are awesome. The technical research is awesome. The people are awesome. And so that's never been our problem. Actually having enough people to exploit that intellectual property. Your salespeople, your marketing people, your people who have done it before, the people who have made mistakes and won't make them again the second and third time. That's the biggest fundamental change over the last 10 years.
Really?
Yep.
Wow.
So the quality of propositions that are coming in to us, if I was to look back over my 28-year venture capital history, is exponential. Yeah, it's like dancing on ice. The first season when they ran it, your people could hardly stand up, and by the time you're running it now, they're all bloody experts.
I think that mirrors exactly what Stepan said. So that's really interesting at different stages and different spheres of funding. But he said that the quality of the entrepreneur has increased dramatically, and it's maybe not seen as just a cool thing to do as an alternative career, but people actually understand the risks more.
I tell you, I celebrate. So I'm still on the advisory board of Loughborough Business School, where I went, and when we got the first survey back that said it was cool to be an entrepreneur, and it ranked higher than being a Goldman Sachs banker, that was such a day, because the previous 20 previous surveys that have been done, people didn't want to be called bankers, but they wanted the money. And that first one that came back and said, no, actually, they want to be part of a revolution. That was awesome.
Yeah, very interesting. And I got the flip side of that, I suppose, by going to my kids' primary school for a careers day, and every child coming out to the desk saying that they wanted to be a vlogger. Or a YouTuber. That was it. Vlogger or YouTuber. And it's like, I don't think anyone in this room can help you with that. Carry on moving. Right, so loads of questions coming in, which is brilliant. Thank you all very much indeed. I've got a few more for Stuart myself, and then we'll move on to those questions. So do keep them coming, and we'll get those answered for you. And again, interested to know if this has changed during the last year. But what would it typically? We talked about grays before, but how long does it typically take raising money with yourselves, and has that changed over the last 9-10 months or so?
So the good news is over the last March this year, I was predicting a really tough time. I just thought, I'm old-fashioned. I like to see people. How am I going to approve an investment where I can't see and touch the management and the founding team?
Mm-hmm.
And I have been very surprised, personally very surprised, that we've managed to find a way.
Mm.
It's been innovative, and you're trying to find different techniques, and it's hard on Zoom because everybody's selling. And so even if I ask you a simple question, you're still selling. So we've tried it, but so actually there is a way to do it, and that's really pleased me. And I'm going to give you two answers, right? We always used to give an old-fashioned answer, which is used to take 90 days.
Yeah. 30
days of you courting me, 30 days of me courting you, and then 30 days for the lawyers to screw it up and charge us. I hope there's no lawyers on this panel. I'm sorry for the sponsors. And that was kind of that was a flippant answer, really. But I think the real answer is you should be selling almost up to 2 years in advance. And what I mean by that is that you should be jumping your escalator. So you should be definitely reaching out to the people above the people that you're selling to,
mm-hmm.
to start to warn them what's coming and what it looks like. And the reason why I say that, is that my investors come back on a Monday and they say, I've met a really cool person, and that person is doing X, Y, Z. They have about 45 seconds to kind of pitch, that initial, this is why we should spend time.
Mm.
That takes a real lot of practice to get down to a point where you can identify the real nub of the problem you're going after with your startup, because sometimes startups don't know what the so actually pre-selling that over a long period of time gives you the maximum chance, so that when the person has his 45 seconds to say, I've met this company, we should really put some more resource into it, it's already been socialized. The concept you're trying to solve has already been understood.
Mm.
The research that's been done, maybe third-party research that's been done that explains why this is such a big problem that you're trying to solve, has already been circulated. It's already been around the coffee shop or in the water cooler, in terms of getting people up to speed. I can't underestimate that this process is way more social than procedural.
Mm-hmm.
And so to answer your real question, it takes probably 90 days to do a transaction. It can take maybe 2 years to build a pipeline of multiple rounds of funding.
Yeah, no, it was interesting because having spent a number of years with Virgin Startup in that early stage, and it was like probably the first question I used to always get asked, how long is this process going to take? And you didn't want to give that answer like, how long's a piece of string, because so much depends on you and when you're going to give me X, Y, and Z that we need to actually make it a viable proposition. So it's good to hear that answer. So appreciate that. I can see more questions coming in as well, which is great. So thank you all very much indeed. And I was jealous of Stepan earlier because he said, I'm just going now to actually go to a pitching event. And he goes, I escaped lockdown, went back home to where he was brought up, which was Tallinn in Estonia. And he goes, I'm actually going to an event with real people who are going to be pitching their businesses to me. And I was like, I actually do feel jealous, because my last live event was 12 months ago, I think, and we traditionally then start up again in February, March, but it's just all went off the shelf. So I was very jealous of him doing that. And I think he said they were the 4th lowest country in Europe with infection rates, etc. So very jealous. And do you think, again, I know you've got a crystal ball, but when do you foresee a shift in getting back more towards the previous model and how you would meet people, and that social element that you talked about before, and getting to actually rub shoulders with the founders and the teams?
So if I just answer a different question, because I just struck one thing that I've I love the concept of diversity, and I'm not talking about diversity from a political perspective or from a sex or race perspective, but from diverse brains.
Mm-hmm.
The reason why I love this job so much, and why it's the only thing I can be good at, is just I just get motivated by diverse backgrounds and diverse brain sets.
Yeah.
And one of the things I have really noticed over this last 10 months is that generation of entrepreneur, and I'm going to age it, just because it's easy for me to, 30 to 40, they are absolutely brilliant at managing distributed teams. Whereas, let's say the 50 to 60 bracket that I'm in, we're rubbish at it. Yeah, we need to see people. We need direct reports that report into us. We need to be able to touch them. We need to motivate them. We need to be able to kick them.
Yeah.
Whereas I have been so impressed with how my CEOs in that younger age bracket just treat it as normal.
Interesting.
And so I do wonder, actually, whether this change, this break will promote more of that behavior, of how you manage people from remote teams, how you get information, how you collect data, how you incentivize, how you check on, motivate, than actually the old conventional way. And the fact that we've done investments where we haven't seen the management team.
Yeah, I mean, it's massive, isn't it? That is,
I personally would not want to be, a shop that purely does deals that way. As much as I now fully understand, quite a lot of the meetings I had were a waste of time.
Yeah, well, that's one of the biggest learnings, isn't it?
On Zoom.
Yeah. Or the length of the meetings as well, I think, isn't it?
Yeah, correct. I mean, I spent 5 years in Silicon Valley, and this is just a random story, sorry. And one of the feedbacks of when we were there, they said, we did some marketing about what's our reputation, and our reputation was those nice English people. And you go, what does that mean? I hate the word nice.
Yeah.
And what it boiled down to was that we were very typically English, which is we'd welcome an entrepreneur, we'd speak 15 minutes about the weather, we'd have an hour's pitch, and then we'd speak 15 minutes about what you're going to do the weekend with the weather. Whereas in our American competition, they were allocating 45 minutes, and the partner would turn up 15 minutes late and leave 15 minutes early. But going through this process, I have learned that it is way better for me to schedule a 45-minute Zoom call to tackle 2 problems that you can actually finish in 45 minutes than to do a typical generic English meeting where we try and tackle the whole waterfront and do 60% of it and overrun by massive.
Yeah.
So I answer you, I do think this will have life-changing behaviors. As to when we started meeting people again, the September time when we were allowed to.
I wondered if you did, yeah.
And I think we will try and do it as quickly as we possibly can. But just so our office was 20% occupied.
Okay.
So people were still working from home doing tasks and then coming into the office to get instructions or to give instructions.
Yeah.
So they were still only in the office 2 days a week, even when we were allowed to be back. And I think that would change. Yeah,
I'm chatting to Magnus Grimmeland, who's the founder of Antler, like the early stage VC. Great guy. Met Magnus a bunch of times, and he was saying to me when I chatted to him last few months back that he said if the one thing that changes off the back of this, that I don't have to fly from one continent to another for a 45-minute meeting and then have to come home again, then I'll be grateful.
Yeah. Yes. I has definitely analyzed. I've looked at my time, and I think what I've worked out is that if I did fewer but longer trips and had a goal of making a difference as opposed to the goal of attending a meeting. I think that's what I've actually taken away from this session is be very mindful of your time and the impact that you want to make.
Yeah, no, I agree. And moving on from that, actually, and when it comes to businesses who are pitching to you, and again, whether are there any differences that you've noticed that what's the best way of phrasing it? That you prefer, that you think works better, maybe that's right, that works better in this new way of doing things that people could maybe take away who are watching and listening to this compared to like the physical?
Yeah, so go back to my analogies. For when my kids, my son was between the ages of kind of well, he's 17 now, so between 6 and 17, I coached football in the winter and cricket in the summer.
Mm-hmm.
You're wondering where I'm going to go with this analogy, but actually being a being a sports person, I think entrepreneurs should start off their relationship with their VC like they're coaching kids. And I don't mean baby kids. I mean, when I was coaching the under 18 football team, I'm coaching them how to play as 11, right? I'm coaching them, what our formation we're trying to achieve is, as well as how to pass the ball and when I was at Loughborough and they coached elite athletes, they didn't teach them how to throw. They didn't teach Steve Backley how to throw the javelin. They taught him what calories to eat and what what exercises to do and how to mentally prepare himself for competition.
Yeah.
And I think the same in the pitch, right? When you're first talking, don't tell me how it works. Tell me what it solves. All too many people want to say this is the best widget ever because it does. Because when you break it open, and it's like,
no,
I don't
what
care.
am I going to get from it? Yeah.
If you think about my 45 seconds, I've got to replay this story back to my team. They're not going to want to know that. And if they do, then actually what they want to know is the person that's invented it has got a PhD and has come from this university and has done it before.
Yeah.
And so I talk about keeping it high and you're selling the investment thesis and the reason why what you're doing will result in a change. When you actually get into further down the process, and I'm committed to you, and you and I are going to work together for the next 10 years, then you can start telling me the intricate bits of how it works. But in those early pitches, Guy Kawasaki from the original Garage, when I was out there, he always told me 8 pages, 3 points on each page, 48 font. If you get any more complicated than that, the message gets lost.
Really?
And so if any of you can ever remember, you've got kids or have watched when the football coaches shout at the kids to do stuff. After doing it for so many years, I worked out the kids could only hear 3 words. And so if you wanted to give them a coaching tip that was longer than 3 words, they couldn't do it.
I see. Really? Yeah. Okay.
Yeah, get back was about as much as they could do, or push forward was anything technical. And I think it's the same with a VC. You got to pitch the story as high as you possibly can, so that the bit that they take away, they understand what change you're going to try and achieve, why it makes a difference.
Really good. I like that. I like that a lot. Just seeing, where was that question I just had? I've just had it up. I've missed the name, but they said, am I too old at 60 to be pitching? Is it too old to be pitching?
My semiconductor investor is 75. And I don't think you're ever too old.
Good.
I think you have elephants in the room, and I went through a phase in these talks about calling them dinosaurs, not elephants. But when you have something that's obvious, yeah, someone's going to look at you and think, have you got the fire? Have you got the passion? Have you got the my view? Just deal with it.
Yeah.
Yeah, and deal with it with integrity. Head on, because you're clearly not, for the greatest respect at 60, you're clearly not going to be a 24/7 CEO for the next 10 years. But I guess that if you said my job is to get it off the ground, and then my job is to hire that person who's
Absolutely
doing it,
yeah.
then that deals with the elephant. As a venture capitalist, I'll only remove people from my investment committee for two reasons. One is obvious, which is lying. So I've only asked kind of one person to pack up because I didn't think they were telling the truth. And the second one is not listening. And sometimes the not listening can be yourself. You're not listening to yourself speak.
Yeah.
And so I know this is around. So 60, no, you've got no problem with age. The problem I would deal with it head on, which is
I think it's great
how
advice.
you recruit the team.
Yeah. And there are enough stories out there, and apologies, I missed the name of who put that question, but there are enough stories out there that you can easily find with a Google as to who started businesses in their 60s and 70s. And we're talking, billion-pound businesses as well. But like you say, I think recruiting, Stuart comes across really approachable. Does he consciously change from good cop to bad cop? And from Paul Smith, head of development at Biomation. I love it.
So I spend most of my time running a public company now, and so I do a lot less investing, and so I can be very approachable because actually, when you come to come to Draper Esprit, you'll speak to one of our investors really, and so when we do, my style, Percy's style, is to be honest and open, and sometimes that comes across as quite cold. If I'm on a company and we're not going so well, some of the feedback can be quite harsh. But I've learned in my career that actually, if you do it with an open palm, which is, I'm not being critical of you personally.
Yeah, so don't take it personally. Yeah.
But this sucks, right? We're not selling anything.
Yeah.
Or the buyers aren't buying what we're selling. And what's the definition of a fool? The person who does the same thing over and again.
Yeah.
And so I'm not a shouter, and I'm not a screamer in that regard, but I am blunt. I guess if that's my bad cop.
Yeah, you don't give the hairdryer treatment then.
I'm not that type of person. My co-founder, we always did the yin and the yang.
Yeah.
He's better at it than I was.
Taz from MN Venture Partners says, what is Draper Esprit's USP relative to other VCs? What would you say is your value add? And that was going to be one of my final questions, but Taz has asked it already, so let's ask Stuart.
Yeah. So I think venture capital things do three things, and I think anybody who tells you that they do more than that, I think exaggerates the point. We help people hire. That's not finding you the person. That's helping you land the person. I always use this example in New York because you can get the image of them being more coin operated and more, less loyal. But if you think about that salesman in New York, he has a choice of the best business in New York, the best well-known business in New York, the most funded business in New York, and then some startup in England that he's never heard of. So why should he join? And so I think the best VCs, you help in that process. Give confidence to the candidate, get the candidate to take the jump. I think they help you fundraise. So if you've been in the game as long as I have, the market is not very big. And so most people.
Yeah.
And so it's how do you get 10 minutes with Matt Miller at Sequoia when he's next on his UK trip, to work out whether Sequoia could be your US partner. or the Boston guys or the New York guys, or even as I was this morning on Zoom in Tokyo, trying to get Japanese investors. So I think that's what we do. And the third thing we do is we stop entrepreneurs making the same mistakes that the previous entrepreneurs have made through our experiences. And that can come from my own personal experience, and it can come from our institutional experience. I.e., if you've backed as many companies as we have as a firm, you start to pick out the patterns. If one of our companies is raising debt, why don't you get the aggregated terms from my CFO to know whether the terms you're being offered are in line with the market? If you're trying to hire someone and give them options, why don't you find out what the other sister companies in your same kind of zone are offering options for that CTO? It's that type of intelligence that adds value. We have that added value in Draper Esprit, which is we're not set up the same as any other fund. Funds at the institutional level are set up in a 5-year invest, 5-year harvest model, 10-year funds. I have no idea why we back the most entrepreneurial people in the world, and yet the corporate structure we use is the same corporate structure as 1958. It's ludicrous. I mean, why do you think Elon Musk drives a 1958 car? It's just ludicrous that you would that you do that. And so I talk about a relationship with an entrepreneur going on for 10 years. So if I invest in year 4 of my fund, my closed-end fund, I've got to start seeking liquidity after 6 years, even though I know that it's another 4 years to get to maturity. So at Draper Esprit, because we're public and because we invest off our balance sheet, time is not that constrictive. So we're able to offer our entrepreneurs a different funding cycle and a different mechanism. So that was.
Very good, very good. Ivy, founder and CEO of the Science Writing Revolution, asks, is it safe to assume that Draper are open to pre-MVP startups?
I would, without knowing it. So in Silicon and in our deep tech part of our business, so 75% of our business is digital. The beauty of digital is you can get customers very quickly, so you get revenue. The technical side of our business, 25%, I would say maybe. But if I was to give you a honest answer, most likely would go to our seed funds.
Yeah, no, appreciate that. Tony asks, we need an initial large investment but forecast high growth and potential operational break even in 3 years and profit in year 5, rather going through friends than angels before VC. Is it feasible to go straight to VC, since I see it as inevitable?
So if you imagine the VC triangle, at the top of the triangle, or at the top of the pointer triangle, where the fewest number of companies are, you are looking to raise capital to deliver 100x. So there are only a few companies, in that top part of the triangle, and it's not a quality perspective, it's the size of the market and the type of solution you're selling. It requires a lot of capital. And so as an entrepreneur, if the opportunity and market is not that big, you lose out by taking venture capital, funny enough, because the venture capital swamps you. As you go lower down that triangle in bands, people blur growth for ultimate profits. And so what I mean by that is the very fact that you spoke about cash flow and operating profit in 5 years' time would take out most of my funds in the institutional, because we're not actually that interested in profit. What we're actually interested in is change and growth. And you do that by funding it with equity. There are a much larger group of investors that are interested in growth, but ultimately self-sufficiency, profits, Because if you get to self-sufficiency, then you don't need to raise equity. If you don't raise equity, you don't dilute the existing shareholders, so there's more money kept in the value for them.
Yeah, makes sense.
When you drop down to the bottom list of that triangle, is where the most investors are, which is they want quasi-security, not asset-backed security, but customers and revenue and budgets and business plans that are believable, and they can see that actually their capital is not going to get washed out. That triangle is details the amount of people in each category. So if you were pitching me to go, I don't think you can jump from one to the other.
Yeah,
I think it's an escalator.
Yeah, you made that analogy. Yeah, it's a good analogy.
I would challenge your assertion. You can jump from families, fools, and friends, to angels, to institutional capital just because it's inevitable, unless you have got some proof points that means you can enter the stairway quicker.
Yeah,
Higher
great answer. Okay, a bunch more questions. In a typical funding journey, can we expect to be adding investors as the company grows, or do we look for exits as the company grows and add larger investors in each round? So is it rare for investors to remain invested in a company pre-seed to IPO?
That is a great question.
Good question, yeah.
I'll give you another quick, no, look at the time, another quick analogy. So I go over to Silicon Valley, 1999, August, top of the party, right? We are talking boom, .com, super duper. It takes me a while. I'm quite a personable person, and I quite like people. So but even that, it takes me a while to get to meet a big shot at a venture capital firm on Silicon Valley. So I get to meet this guy, and he says, "I'll meet you in Nola's." Nola's was a wine bar. That was really odd because Americans don't drink. Certainly not professionally, don't drink. So that's cool. I'm going to meet someone who's European in outlook and is quite happy to meet me for 5 o'clock for a drink. Anyway, we get to Nola's. I ask him what he wants. He says, "I can't. They say a martini." I go and get my beer. I get a martini for him. He sits down. I talk to him for 2 minutes. He drinks his martini. He says, 75% of my problems with my portfolio companies are my existing investors. Why do I want another problem? Got up and walked out and stuffed me with a bill. And so to answer your question, yes, a seed investor can stay the whole journey. What is happening recently is because investors want to put more money to work, they are offering jump out points for early investors. And I think this is real progress, because if we can get to a point where people can invest early, come out the middle, go back in late if they wanted to, I don't know, buy a share in Draper Esprit, which enables them to participate in the late stage type stuff. And actually, we enable investors to jump in and out of this asset class as they see their risk profile. I think that is awesome. And just another, sorry if there are any French citizens on the call. If you look at Paris and Berlin, or Paris and Stockholm, one of the big differences between those ecosystems is the volume of exits. Exits breeds confidence, not from the entrepreneur or from the VC, but from the investors. And we had this in the UK, based in Cambridge. Cambridge is its own ecosystem. It has a lot of angel investors. When Cambridge started to generate successes and exits and cash started to flow back to those angel investors, the network of angel investors grew.
Yeah, absolutely.
People got more confident. I put 10,000 in, suddenly I get 200,000 out. Well, now my minimum check is 25,000. 50, and that confidence from the investors is what breeds success.
Yeah.
And if you look at ecosystems, for them to be successful, yes, you need seed funds. Yes, you need capital, yes, you need events and you need community, but ultimately you need confidence, and that comes from cash.
That's a great story. Great story. This was a good question as well, which I've had a few times recently, well, more this year, I think. C. Thompson, founder and CEO of Alpha Beta, who says, overall statistics show that the majority of investment is awarded to male teams, over 90%. Do you have any tips for single female pitchers?
I think the only way we deal with this issue, which and I think it's across the board.
Yeah.
I think female, I think BAM, I think poor regions, I think outside of London from a UK perspective. So I think you have to do it on multiple fronts. So what I've done as the only thing I can do is affect my world is I've made sure I've hired the most diverse team I can find.
Mm-hmm.
I mean, we are still underrepresented from poor backgrounds. Being honest.
Mm-hmm.
Because we take university graduates plus 4 years, 5 years of experience. So we're still working on how we get more people, from across societal. To answer your question, I think I do think from an underrepresented side, they have to work harder, which is unfair, I know, but they have to work harder at this kind of testing. This, let me test my idea with you, let me meet with you before, let me pre-test what I'm talking about. Is this area of interest for you? Because that is how you get the direct feedback to certainly if you pitch to me. I mentor a lady down in Petersfield who does who has a marketplace. It's actually through the pitching the ideas you actually go, I wouldn't say that. I wouldn't be apologetic for that. I wouldn't try and defend that point. That's not your elephant. That's someone else's elephant. I would never pitch as a single male or a single female. I would pitch as a team if that is possible.
That was another question, so it's good that you've kind of segued into that, because that was a question. If you were a solo founder, how is it viewed, and is there anything one could do to negate concerns with being a solo founder? Yeah.
I think you deal with the elephant, because nobody can do everything. Nobody can do everything. So the very first question you're going to get to is, that's awesome, that's a great pedigree, that's a great idea, that's how are you going to execute it? And so actually coming up with, well, that's why I'm talking to you, because I am going to need help in this area and this area. I've got this area covered. I reckon I can get this person. So I wouldn't, even if I was a single person, I would never pitch a single person.
Yeah, that makes sense.
Pitch me as the lead, but I would pitch, with this money I will build this team, or over the next year I will supplement this team.
Yeah, really good, really good. Okay, probably coming up to the last question, folks, which have been inundated for. I mean, this today has been the busiest day for engagement, which is awesome. Tony asks, is it important to have control of 51% of your company to make decisions unilaterally to prevent disagreements such as the pay package of the founders and key members of the team, where you may need to pay a premium but investors may not agree? Good question.
So my answer is no. As a venture capitalist in 28 years experience, I have got only one retort to a management team that says, I don't want to do that. And that's to fire them. And that is value destroying. So if you get to a point where actually it's that confrontational, then obviously relationships suck.
Yeah.
But I'm an economist from my academic life, and the only thing I can remember from my economics degree is Adam Smith and the Wealth of Nations. And you need materials, and you need capital, and you need labor. And if your materials are your intellectual property and you are the labor, you've got two legs of the three-legged stool. You always need the capital. And so my question comes back to you is, well, I'll do it two ways. One is, I have never met a founder that starts with money as a driver, right? So I've met very many greedy founders, and but I've never met one that, certainly not a successful one. And I've never met an investor that will go against the management team.
Right. Okay. Yeah.
In terms of I know best. And so I would say you don't need 51% because you hold the aces.
Yeah.
If you abuse it, then that's it. But you don't need 51% for that reason.
Great answer. Okay, a couple of quick ones maybe to finish off here. Justin Smith asks, any particular seed funds you have partnerships with in the prop tech space?
Oh, there was a specialist. There was a specialist one in London that was. So I would have to get back to you on their name. I would have to basically Google my mailbox to find out what the chap's name is.
Yeah. Okay. Great. And yeah, loads of comments, which is great. Thank you very much indeed. Last one maybe then. Stephen Daniels, director of Just Right Products, says, does granted patents, some globally spread and the patent box scheme make a positive difference to investors? A range of products from these that cover bondage to construction.
Look, let me give you my look. I'm not a politically correct person on this front, right? I'm a software investor, and patents have never helped me. They have got in the way in that I've had patent trolls come after some of my companies, but that's something else. And so I find patents can take an awful lot of time and not help you. Well, what I mean by that is if you think you have a patent for your idea, Google, Apple, Samsung, Intel, IBM, they don't think about single patents. They think about families of patents to basically box your one patent in. That means even if you had $3.5 million, which is what it would cost to take a litigation, you wouldn't win anyway, because they would basically surround you with their family patents. So I know I'm very biased in this, and I know it's not the right thing to say, but unless you were in a more deep tech environment, I worry about patents and your efforts.
Yeah.
Just because you can't defend them.
Thank you. Last one then, here we go. We've got 2 minutes left. Tony, any red flags that we need to be aware of when choosing an investor? Anything we may come across where we need to think twice before bringing them on? That's a really good point to end.
It's a really good point to ask. I am always shocked at how few entrepreneurs take references on us. I mean, if you were to hire someone, you wouldn't just take a pitch and hire them. So definitely take references of entrepreneurs they've backed, maybe some they haven't backed, maybe some that they've sold out of. TechCrunch is great to find out who's been associated with who. Even asking other VCs what they think of Stuart. So I think that's really important. The biggest bugbear for me, though, is I'm trying to make sure my language is clean. BSers. So VCs that talk everything up, and then you find out they've got a $30 million fund. And so you've just taken $750,000 from them, say, and they can't follow their money. Or they can't raise a new fund because performance has not been so great.
It's not deep enough.
You're stuck. I mean, that to me, I think that entrepreneurs need to do a lot more work on that. And then my last one is the reason why I am a VC is because I would make a rubbish, tech entrepreneur, right? So if you have a VC that tells you how to run your business, run for the hills. If you have a VC that says, hang on a minute, I've seen this before, this doesn't play out very well.
Yeah.
Listen, reflect and respond. If he says get aside, I can do this better than you, then just, I tell you, run for the hills.
Run for the hills. Brilliant. Well, look, apologies if we didn't get to your question. I know there's still questions coming in, but we would literally be here all day, I think. People tapping into your knowledge and experience there, Stuart. So appreciate that. Easiest place to direct people, I would assume, is going to be draperesprit.com, where you can either meet you or pitch to you, essentially. And now you've got a new campaign up and running, new website there that's really obvious for people which route to go down.
As I say, it won't be for me because you'll go to the investment team. If you have something personally for me, you can get me on LinkedIn and ping me a message from there. I'm always happy to answer over the weekend.
That's great. Thank you so much. Really appreciate you taking an hour out of your day. Thank you so much.
Loved it. Good luck, everyone.
Yeah, thank you, everybody. Just to let you know, I'm going to press end session now. And there's an exit button down the bottom right-hand side of the screen as well. We are going to open our virtual networking again at 1:30, and then I'll be welcoming my good friend Piers Linney back for a session today. We're going to be talking for an hour from 2 p.m. So come and join us then. Thank you very much, everybody, and have a great rest of the day.